Today I'm going to cover three topics. Firstly, Ireland's recent growth numbers. Secondly, to explore the somewhat unfavourable trend in recent conditions. And the third area is to once again look at our US recession watch. So with recent growth numbers for Ireland, the 5-year run of spectacular growth has continued. There are some signs that growth is a little bit slower than before. So to some extent, GDP doesn't really provide a great guide to Ireland, so we focus on our preferred indicator, which is gross national income, or this modified GNI star. And growth in that case is around about 3%. The domestic economy is growing at similar rates, but we have seen a little bit of a slowdown in consumer spending, where growth is closer to 2%. So if we look at how Ireland's doing versus our peers, we're not growing quite as fast as we were, and the gap between Ireland and our peers is slowing, but we're still very much in the vanguard across Europe. I think the answer is to look at external influences on the economy. So for Ireland, as a small, very open economy, things like currency fluctuations, interest rates, oil prices matter a lot more for us than for countries with big domestic markets. Let's say if we rewind to 2015, everything was in Ireland's favour at that stage. We'd seen the collapse in oil prices. We saw the European Central Bank start its bond buying programme. And of course the euro was very weak. Today, some of those things have changed. So the US economy, which we'll talk about in a moment, is still very, very strong. But we've seen the ECB move to ending its bond buying programme. We've seen oil prices actually increase by 50% over the last year. And then, of course, currency fluctuations haven't been as favourable. The euro has strengthened a touch, particularly against pound sterling. And of course, for obvious reasons, we've seen the British economy, our second biggest individual trading partner, slow over the last year. Well, the US economy is still really strong at this point, boosted, of course, by this unusual fiscal stimulus at this point in the cycle. And as my colleague David Perdue outlines in a note also released alongside this presentation today, Ireland is more reliant on America than it ever has been in the past. Ultimately, we will look at the bond market for signals. So one very important signal is to look at the US yield curve. And what we're looking for in that case is inversion. In other words, when longer term rates go below short term rates. Because again, as we've mentioned before, when the US Central Bank starts hiking interest rates, it tends to be a significant guide to slowdowns in the US economy. The great thing about looking at, say, 2-year yields going above 10-year yields in the States, and the gap is still about 0.25 percentage point, is that it has been such a reliable signal in the past. Every US recession going back to 1957, so over the last 60 years, has seen that inversion of the US yield curve. Not only that, we get some lead-in time, so we get a gap of about 6 months to 2 years before you go into a slowdown. So there's no immediate cause for concern about Ireland's credit spread, but in the NTMA, we like to prepare. So that is one of the reasons we've funded about 12 months in advance.